It's time for the Phil Ferguson Show.
Buongiorno tutti. Hello, everybody. This is Phil Ferguson, and of course, you are listening to The Phil Ferguson Show. It is January 2018, and I think this is show 245. Yeah, let's go with that. Fingers crossed that I got that right. I have got a lot going on, and I am having a hell of a good time doing it. One of the little things, not so much fun, but, just kind of interesting. My fancy schmancy cell phone, I had it plugged into my car, and it started going crazy and vibrating, and unplugged the power supply, and it was really hot and smelled like melted plastic. And I got home, I plugged my phone into another cord, same thing. And so I ran up to a cell phone repair store, and apparently the little charging port in the base of the phone has a glitch or a short or something in it. And so I can't charge it. Well, I can't charge it with a cord. Thankfully, this has that magical QI technology, and I do actually have a wireless charger that I can charge it on. But I only now have one way to charge my phone. So if I go somewhere, I have to take the little portable wireless charger thing with me, which is going to be real inconvenient. So they've ordered me a part. So we've got that fun stuff going on. Later in the show, we are going to have an interview with Charone Frankle, and she is going to talk about her podcast, Habeas Humor. It's a combination of legal stuff and a little kind of a comical spin on it, trying to make it fun and entertaining. Greatly appreciate that. I've got more stuff than I really want in the show, but sometimes that happens. I've got to talk about Warren Buffett's 10-year bet. He won, by the way. That's the too long didn't read version for you, but I'll go into some more details about that and how the big bad media has it all wrong. That's kind of not really the big bad media, but there's been a lot of stories about it, and it's technically true that he won, and he won by a lot. But they've got the math wrong, and I'm going to go through that. And then it is the big beginning of the year review of the previous year. So I'm going to go over a lot of statistics and numbers and data of the events that happened in 2017 as far as the market's concerned, different types of investments and how they did. And after I go through all of the facts, I might express some opinions and kind of give you a feel, a vibe for what I'm thinking. And we're going to do that. And of course, before we get into all that, I've got an email, and I'm going to paraphrase this very roughly because it was a long and detailed email, which I appreciate because it helps me understand their specific situation. But you don't need to hear all of that stuff. But it's someone that basically has two different brokerage accounts. One has managed funds in it, and one has all index funds in it and ETFs. And it doesn't matter where they are or why they have two different funds, but they do. And they wrote saying, "Hey, Phil, I'm looking at my year-end statements," because it's that time of year, and the managed funds have these pretty good-sized capital gains that, I'm showing all these capital gains, which, of course, then get reinvested back into the account, and the index funds and ETFs don't hardly have any capital gains. So A, kind of what's going on here. B, am I losing out? Am I missing something? And are the managed funds therefore better because I'm getting capital gains that the index funds are not getting? So can you kind of explain that to me? And I thought, hey, you know what? This sounds like a fun show topic, and I can handle it in just a couple of minutes. So the first thing to go over is there's, in stock investing, in bonds too, but mostly stock, there's two types of taxable events that can occur. One is short-term gain and one is long-term gain. And a short-term gain is from something that happens less than a year, and a long-term gain is something that happens more than a year, assuming you have a gain. The short-term gains can be caused by two things. One, stock dividends. All the dividends are going to be short-term gains, and they get added to your taxable income, and you pay your marginal rate, which might be 20, 25, 28, 33, 39.6, something like that. Then you also have long-term gains, and long-term gains are gains that you've realized for something that you've owned more than a year. So bond dividends and stock dividends, they don't qualify for that. But if you bought a stock, and make it real simple, for $50 and you owned it for a year plus and you sold it for $100, you have a capital gain, a long-term gain of $50, and you've got to pay tax on the $50 that you made. Okay. Now, when you have a managed fund, any and all taxes that they incur, they share. I guess they have, you have to pay it. They don't pay the taxes. You have to pay all the taxes. It's your money. But they send you a report. And the report will say, during this year, because of dividends and trading activities and the decisions we've made, here are the effects. Here are your short-term gains, and here are your long-term gains. And you either type that into your tax program or you hand it to your tax preparer, and you pay the appropriate taxes on those gains, short-term and long-term. The more activity a mutual fund has, or the more activity you have as a trader, so if you're a day trader, the more of your gains are going to be taxable in any given year. So an actively managed fund buys and sells stocks during the year. They might sell 20% or 50%, and some of them might even sell 100% during the year. And so if they create short-term activity, all of that adds to your short-term tax consequences, which you are likely going to pay at a much higher rate. However, if they own a stock for a year and a month or a year and a half or 2 years, and they sell it then, you're going to get long-term capital gains. So mutual funds can have half of the turnover, 50%, or more than 100%. And the average managed mutual fund is usually around 100 to 120%. So it creates a lot of short-term gains, and it can also create long-term gains because while they keep selling some things quickly, they might own some things more than a year. Even though the turnover is more than 100%, some assets they hold more than a year. So if you don't sell anything, so if you have 100 stocks, and this would be the same if you're buying on your own or if you're an index fund, if you buy 100 stocks and at the end of the year, all the dividends that you got, you're going to still have to pay ordinary tax rates on it, your marginal tax rates. But if you sold none of those stocks, you will have experienced no gains from the increased value in the stocks. Well, at least you've experienced no taxable gains, I should say. You've gotten a great gain, and this year it's over 20%, but you've had no taxable gain. And so if you bought it for $100,000 and at the end of the year it's $120,000, you'll pay tax on the dividends, which right now in the U.S. stock market around 2%. And everything else, the other 20% of appreciation, you don't pay any tax on it. Nothing. So this is why with index funds, even inside of a taxable account, your taxes can be really low, and why index funds are often considered to be highly tax efficient. Now, at some point, the index fund will buy and or sell some things. And when it does, you will generate some long-term gains, but the long-term gains, long-term taxable gains in an index fund or an ETF will often be a small fraction of what you experience in a managed fund. Now, even in the index fund or an ETF, if you hold it 5, 10, 15, 20 years and you retire and you start pulling money out, you will have to pay all of the capital gains taxes then. You don't get to dodge the taxes, but you might get to delay them. You could argue that you eventually pay them anyway and it doesn't matter. But what you lose by that trading activity is the ability to compound those returns year after year after year after year. So when you get a market year like this, if you make 2% in dividends and 20% in appreciation, if you bought and sold everything, you might have to pay 33% tax on the 20% that you made from appreciation, or about 6.66%. Ooh, clever. So you didn't get to keep 20, you get to keep 14. So next year, if you make 10, you make 1.4. But if you kept all the 20% returns, you make 2% more next year. And that adds up a lot over time. So that is what is happening. They're reporting more long-term gains. They're reporting long-term taxable gains. So you're not making more. More things have triggered tax consequences. So unfortunately, in this case, the managed funds are not better. They're worse. They're creating greater tax consequences for you. So what looks like extra money is actually just extra tax. So it's one of the reasons that I love index funds. So that's a little bit about how that works. The next subject is Warren Buffett, and he had a 10-year, $1 million bet. And a lot of this is pulled from his annual letter. It's the 2016 letter. I'm not aware that he's put out the 2017 year letter yet, but you can find it yourself at berkshirehathaway.com/letters/2016LTR 2016 letter.pdf, just in case that doesn't work without it. berkshirehathaway.com/2016LTR.pdf. That happens to be, I forgot off the top of my head, I think it's like a 30-page document. Everything about Berkshire Hathaway, everything about Warren Buffett, all of his thoughts on everything he wants to talk about from the last year. Very, very informative read. You might get a lot out of that. But it just so happened in the 2016 letter, he talked about a lot of this and had the details there. And that's why I know some of the specific details of the story, because that's the best source for it. But I got a lot of emails and people were sharing me links on Facebook about the bet's finally over. Yay. And I knew it was coming because the 10 years have ended. I covered this at the end of 8 years, I think, and at the end of 9 years. And even 6-7 months ago in May of 2017, because the guy that Warren Buffett bet against had conceded the bet before it was even over. So let me back up a little bit. As far back as 2005 and probably before, Warren Buffett was trash talking hedge funds. Basically, in my vernacular, not his, they're a complete and total piece of shit. The expenses are phenomenally high. They follow up a thing called 2 and 20. So if you make 10%, you have to pay a 2% management fee per year. And you also pay 20% of what you made. So if they make 10%, you pay another 2. So you pay 4. You pay 4 and you get to keep 6. If you make 20%, you pay 2 plus 8, which is 20% of, yes, 4, 8. Yeah, 4. So you'd pay 6%. So it can be very expensive. And of course, if you're going to pay 2 and 20, they have to do a lot better than the market for you to have a chance to keep up with the market. And as a whole, they don't. And we've done whole shows on that, so I'm not going to spend a whole lot of time on that. But Warren Buffett was talking about that, and he laid down the gauntlet. He challenged anyone that would step up and make $1 million bet with him. He bet that over a 10-year period, that the S&P 500, as measured by the Vanguard S&P 500 Admiral Shares Index Fund, would beat any basket of 5 hedge funds that they would pick. Only one person took up on this bet. And his name, and I don't know how to say this, so forgive me. His first name is Ted. I can handle that. Ted Sides. I'll just go with Sides. Seides. He's one of the founders or the founder of Protege Partners, which is a very large hedge fund company. Took Warren Buffett up on this bet. They didn't each put down $1 million. The total value of the bet when it was done in 10 years would be $1 million. They both put, I think, like $300,000 into some zero coupon bonds that were then held, and the two contributions added together plus 10 years of interest would be worth $1 million at the end. Well, the funny thing is it ended up being $2.2 million because as interest rates fell, these zero coupon bonds, or they're a type of long-term bond, they went up. We've talked about that on the show. When interest rates fall, long-term bonds go up. It became worth quite a bit more than what it should have been. And then they were concerned, like I've talked about on the show, that interest rates would start going back up and the value would fall before the debt would be finished. And so they took all the money out of the zero coupon bonds and actually put it in the Berkshire Hathaway stock, and that went up as well. So it then became worth $2.2 million. The interesting thing is some people think that 1 million turned into 2.2 million because of it being in Warren Buffett's company. That only occurred during the last 4 or 5 years. So 5 or 6 of the years, it was in zero coupon bonds that went up a lot as interest rates went down. But the final numbers, this is where it gets a little tricky, because I looked at a lot of stories and it looks like they all referred back to a brand new story right after January 1st from the New York Times. I can't see the full story at the New York Times because it's behind a paywall. Now, maybe I could clear my cookies or try from a phone or a different device and I could eventually get the story, but it doesn't help because you can't go see it either. Unless you can find a trick and maybe we can all go look at it. But everyone else quoted this story and said that the S&P 500 over the preceding 10 years had an annual gain rate of 7.1%, and Protégé Partners and their basket of funds had an average return of 2.2% per year. And I just happened to know that that number was wrong because last week I did the show where I talked about the S&P 500 performance and mentioned that over the last 10 years it was 8.5%. And so I thought, well, where in the fuck did this 7.1% come from? It comes from that letter I mentioned at the beginning of this segment that Warren Buffett put out in the beginning of 2017. So the New York Times didn't bother to update the number, and apparently no one else bothered to even check the number. And so, that kind of was sad, I guess. If you make 7.1% per year for 10 years, you make 99%, which is how we come up with the 72 rule of 72s. If they made 7.2%, it'd be about 100% over 10 years. However, because the market averaged 8.5 and the long-term norm for the stock market is 10, the total return was 126%. The 2.2% for Protégé Partners also comes from that same document that Warren Buffett put out a year ago. And since he either has not put out the new letter or I could not find it yet, I don't know what the correct number is. What I did was I extrapolated the number and came up with 3.5% is a very likely expectation of what the Protégé Partners average is. So 8.5 compared to 3.5. And you might think, okay, 8.5 compared to 3.5, the difference is 5. Warren Buffett won by 5. Well, that's way too fucking oversimplified because we have compounding in effect here. And so the real result is if you had $1 million to invest, since it was $1 million bet, let's have fun with that. And you put $1 million in the S&P 500 10 years ago, or you put $1 million, $200,000 each in the 5 hedge funds that Protégé Partners picked to be part of this bet. Here are the results that you would have achieved. With the S&P 500, your 1 million would have turned into 2 million. Let's see, do I have this right? Yeah, $260,000. $2,260,000. The hedge fund turned into about $1,350,000 is my estimation. I don't have the actual number for that, but it's going to be in the ballpark. I could be off by a little bit, but it's going to be in the ballpark. So people go, oh, okay, so it's, a bigger number. Yeah, it's a bigger number. If you take out what you started with the S&P 500, you made 1.126 million. With the hedge funds, you made 350,000. So which would you rather have? $1.25 million or $350,000? The hedge funds underperformed by almost 90%. 90 percentage points lower. So you could make $1.25 million or $350,000. That is the power of the S&P 500. Now, the guy who lost, he said, I love this. He said that he thinks that if they bet again, if they did double or nothing, that he'd win the next time. Now, I think if I'm Buffett, I'd come to him and go, well, I don't want to say double or nothing because we're going to give this money to the charity, but let's make another 10-year-long $1 million bet. And maybe 10 years from now, we can laugh at the guy for losing the same fucking bet twice. Oh, gosh, wouldn't that be great? So that is the story. The final results are in on Warren Buffett's 10-year, $1 million bet. The final result for the S&P 500 is 8.5% per year. And my calculated and not necessarily precise, but in the ballpark number for the hedge funds is 3.5%, a loss of almost $900,000 if your initial investment was $1 million. I guess not a loss, but a dramatic underperformance. So that's the little fun story on that. And it's just one of those times. I've got a lot to cover this week, so we're going to wrap this little segment up. And next up, we are going to talk about market performance for 2017. All right, next up, we have market return numbers for 2017. But before I get into that, I'll take a little break here. I have been watching Star Trek: The Next Generation, the entire 7-year box set on Blu-ray and in Italian, just because I figured it'd be fun and I can practice my Italian. And for the price and the amount of hours of Italian I get to listen to was just a fantastic deal. I'm now most of the way through season 3 out of 7. And at the end of season 3 is when we get real serious with the Borg. So I can probably soon, maybe next show, finally give the answer of what it sounds like when the Borg says resistance is futile. But in the meantime, I just heard this and I thought you guys might like this. So I'm going to play a little sample here from the show and see if you recognize it in Italian, of course.
Pace e lunga vita. Lunga vita e prosperità.
Ooh, okay, so that was Jean-Luc Picard talking to Sarek, who is Spock's father, of course, for all my Trek fans. And Picard said, peace and long life. And Sarek responded with long life and prosperity. And, live long and prosper, is the original English. So lunga vita e prosperità. Long life and prosperity. So that is what they say for live long and prosper in Italian. How's that for cool? And hopefully we'll have the Borg giving their famous quote soon. But I tell you what, I'm genuinely surprised and delighted how much joy I am getting from watching all of these Star Treks back to back. Just the future world where pretty much everybody gets along. Of course, there's conflicts with aliens, but just the advanced society and all the magic, and so many of the shows are just so wonderful and touching. Just really, really having a great time. And I just recently watched the episode where Data created a baby for himself, a young woman, a child, I guess, and then she died. And that, oh my gosh, that was sad. Anyway, so now we're going to talk about stock market returns. Actually, I guess we're going to talk about all kinds of returns. So it's not just stocks, but bonds too. So these are generally going to go in order from most conservative to most aggressive. Kinda. But generally, that's kind of how this is going to flow. There's going to be a lot of numbers. So if you really want to understand this or map it out, maybe while you're driving is not the best time to listen to this part of this episode. But it's just for reference. It doesn't necessarily mean that this is the end all of be all. But, just something I like to do to give you a reference point. And it's also that time of year where hopefully in the last few days or the next few days, you get your statements from your brokerage firm or mutual fund company, your 401k, your 403b, whatever kind of investments you have, and you can pull them out and figure out how much money did you make last year? What percentage, not the dollars, what percentage did you make? And compare your results to these numbers. If you're dramatically under, well, then you may have a problem, and you might want to take a look at trying to fix it. So the first thing is money market. And money market is basically kind of cash on hand. That number had gotten down to a yield because the money market's generally it's worth $1. It's always worth $1 per share. So the share price doesn't change. You just get interest like a savings account. It has been under 0.5% for many years now. But the current yield is now 1.4. And the 1 year actual just ending year was 1.02. 3-year average is half. 5-year average is 0.3. 10-year average is half. So that's where it was way under 1% for a long time. The long term since 1975, the average has been 5.03%. Remember when you could make 5% in a savings account? And you could make even more just in a money market account. So things were different then. This is why some of the opinions and ideas and thoughts and information I give change over time. So if you're hearing a segment a couple of years after it was recorded, just keep that in mind, that the date, the information may not be as relevant as you think. Next, I'm going to go to short-term government bonds. And these are all measured by, I pulled all these numbers from the Vanguard index funds because they're so easy to get. You can easily get them. Anyone can get them. And that's part of the investing skeptically shtick, is that you can go get this yourself. This specific fund's letters are VBIRX. Current yield, 2.08. Performance for the last year was 1.2. 3 years is 1.2. 5 years is 1 per year. And the long term since 94 is about 3%. So again, making between 1 and 2. In the long run, it used to make 3 and or more. And short-term interest rates are going up, and the current yield is 2.08 or 2.1%. And that's kind of a baseline investment, something that's not cash, making 1.4, but short-term bonds making 2.1. And with any bond, if you ignore default rate, the yield should tell you what you expect to make in the long run owning that investment over a period of years. And what happens in the short term can be very different from the yield, but the shorter the term or the shorter the average maturity of the bonds, the more likely that is to be precise. So if you invest in short-term government bonds, you're probably going to make 2.1%, give or take, this next year. It's going to be in that ballpark. So that's kind of nice. If you go to short-term corporate, the current yield is 2.4. And in the long run, that has averaged 6% since 82. So, just some ideas that makes a little bit more. Since they're corporate bonds, there's a little more risk. No big deal. Intermediate term government bond, current yield is 2.15. And the long term on that doesn't go back anywhere near as far. Oh, wait, here it is. About 5.96% again. The long term, this is where you can get a lot of volatility and where I've been recommending against. The current yield is 4. Actually, it's 4.02. And in the long run, it's 7.9% per year. That's since 2010, so that's not that long period of a time. There may be a cheaper alternate version of that fund that has been around longer. I'm sure there is. But the real surprise is in the last 1 year, the long-term government bond fund from Vanguard made 8.65%. And that is one of the funds I've been telling people not to buy. I guess I was thinking of doing my opinion stuff afterwards, but I'm going to just slip it in right now. 8.65%, and that's a fund that I've been telling people not to buy. So in the short term, I am wrong. It made 8.65% this year, which really surprised me. And I've been telling people to not own it, to not buy it. And in the short run, I have been proven to be wrong. So put it down. I make sure you understand that I don't get everything right. And sometimes it just comes down to a matter of timing. And the reason primarily they made that much money is because even though short-term rates are going up and are trending up and are expecting to go up, the long-term rates have not yet gone up. And matter of fact, because of the flight to quality from other countries around the world to the United States, the long-term rates have gone down. So let me go over this part real quick. The short-term government bonds, 2%. Intermediate term government bonds, 2.15. Long-term government bonds, 2.67. Not much of a difference. And what they would normally phrase that as is a very flat yield curve. So the yield or the dividends go from 2% to 2.67% in the long term. The expected long-term return from a long-term bond index, government bond index, is going to be about 2.67% per year. So that's what you're going to make. You're going to make 0.5% more, 0.6% more. So it's a higher yield, but long-term bonds are severely affected if interest rates go up, long-term interest rates go up, which so far they haven't. So even though I am wrong for what happened in 2017, not that I was giving a specific time frame, but I kept saying to sell these and not own these, if you ignored my advice, you made 8.6%. At some point, and again, maybe I'll be wrong again, at some point, long-term interest rates will start to go up. It's very, very unusual to get what is called a yield inversion. And in a yield inversion, short-term interest rates pay more than long-term interest rates. And part of why that just generally doesn't happen, it has happened, is that if you can invest money for a year and make more than investing money for 20 years, why would you ever tie up your money for 20 years? It wouldn't make sense. So you would just do a year and then a year and then a year and then a year. So it is expected by the majority of academics, by the majority of economists, by the Fed itself, and by me, at some point, long-term interest rates will start to go up. And when that does, these funds could take a beating. And I'm talking not just not making 2.67. I'm talking about losing 10, 15, 20, even 40% over a year or two. When will that happen? Clearly, I now know not in 2017. The next category of bonds we have here is Ginnie Mae's, housing-based bonds. Yield is 2.76, and in the last 1 year, they made 2%. And the 10-year average for those is 3.65, and the long term is 4.6, and that's since 1980. So, it's a regularly consistent thing. The nice thing about them, while they're generally more like intermediate term in length, they don't change the same way as government bonds do because people generally don't refinance when rates go up. And I also have emerging market bonds. Current yield on those is 4.1. Over the last year, they made 7.6. So for anybody that had money there, we did fantastic. And the long term on that is about 4.5%, 5%, maybe 6%. So it's just another way to make money in bonds. And you're facing different kinds of risks. There's always risks. Every investment has risks. Even cash, your big risk is that you fall behind compared to inflation. So even though you have money, it becomes worth less and less over time. And the last bond category I have here is high yield, also known as junk bond. The current yield on those is about 5%. And the last year it made 7%. And over the long term, since 1978, the return has been about 8.4% per year. So when you start making returns like that in bonds, you should start to expect more and more volatility, more and more risk by definition. Going over to stocks, we did the S&P 500 last week. That was 21.8, roughly. Over per year for the last 3 years is 11.4. Per year for 5 years is almost 16%. And the 10-year, 8.49. We just talked about that with the Buffett thing, 8.5. The weird thing is if you look at it for just 9 years, and this is where some people are starting to get a little skittish. If you look at it for just 9 years, the average return has been 15.25% per year for the last 9 years. If the long-term norm is 10 to 11, 15.25 per year for 9 years is considerably above that mark. And that has some people very concerned. However, is 9 years the right period of time to look at this? Because like I just said, if you looked at 10 years, it's 8.5. If you look at 15 years, it's 9.92. 20 years is 7.19. 25 years is 9.7. all those numbers sound pretty good. The 8.5 obviously is below the norm. The 15.25 is considerably above the norm. So the question is, in 2008, the market dropped. Of course, you might expect better returns going forward. So you can discount some of that. But in general terms, what does that mean for the future? I don't know. If there were a lot of people who predicted the stock market was going to tumble after Trump got elected, and they missed out on something close to 20% increase. And so even if you're right now and it falls, something short of 20%, you could be even. Doesn't mean you're right. But if it doesn't, then you're just missing out on all of the returns over time. But I'm going to break the S&P 500 down a little bit. And at Vanguard, you can do that with the large cap growth and the large cap value fund. The large cap value made 17%. Large cap growth made 28%. So that's a big difference. And this is one of the things that I love to do with accounts that have a little bit more money. This is hard to do with $50,000 or even $100,000. But when you get up to $300,000, $400,000, $500,000 or $1 million, you can start getting these different segments. You can do it with smaller amounts, but the gains versus the efforts are not worth it. So here we have a situation where you can split the S&P 500 into growth and value, and you could make 28% or 17%. And so this is one of the things that I will use as a guide as I monitor accounts and talk about, okay, large cap growth is crushing it. It's ahead on 1 year, 3 year, 5 year, and even the 10-year average of 9.5 versus 7.6. We're starting to get a noticeable discrepancy. So you might look at that and say, well, why do I want value stocks when the growth stocks are doing better? I think the exact opposite. I think you now want to start putting an emphasis on, at least for the large cap, the value position versus the growth position. And right now I'm trending towards a 10% bias between large cap growth and large cap value. So if you have 100,000 in large cap growth, maybe you should have 110,000 in large cap value. Large cap value in the really long run makes about the same as growth, but some can argue probably successfully a little bit more in value, and now it's lagging. I like that. That sounds exciting to me. I want to have more money where it's lagging. If we go to mid cap, we're talking about growth making 22 and value making 17, and small cap growth was 22 and small cap value was 12. But when you look at the 3, 5, and 10-year numbers, you get mixed results. So I don't want to make a whole lot of change because of the results are different for 1 year. So in mid cap and small cap growth versus value, I have them about equal. I might make a little bit of a difference, but the give or take, they're about equal. The other thing, of course, is how much should you have in large cap versus small cap? Market neutral position, large cap will be anywhere from 65 to 75% of the market. The interesting thing is, as large caps do better year after year for several years in a row, which is a position we are now in, they will tend to be more towards the 75%. The ironic thing, or at least the way I look at it, is the better large caps do in relationship to mid and small caps, the more mid and small caps I want. I'm also a little concerned, again, because of the large cap growth doing so well, and a lot of that's driven by a handful of stocks. And those handful of stocks includes things like Apple and Amazon and Google. Will they continue? Maybe. But, they've done really, really well, and so I want to make sure you're not overweighted in those. So right now, if you are, in your 20s, 30s, maybe even 40s, maybe have 40% of your U.S. stock in mid and small cap and 60% in the large cap growth and large cap value, or S&P 500 if your account is a little bit smaller. That's kind of where my head's at. If you are closer to retirement, I'm going to be more of a market neutral position where large cap might be not 60%, but 65 or even 70%, because historically they have less volatility than the small caps and you're closer to retirement. So anyway, there's a lot of weird thoughts going around. Another category I regularly use is REITs, real estate investment trusts. This is the index at Vanguard. For the last year, it made slightly under 5%, and the 10-year average is 7.6. The long term since 1996 is almost 10.5%. So in the long run, real estate investment trusts, the stock units, make about the same as the stock market, but they don't always make it at the same time, as evidenced by the fact that they made under 5% last year when the S&P 500 made 21.8. So that's a nice place to add money because it fell behind. So if you're someone adding money, adding a little bit more into REITs might be a reasonable place for you to add some of your monthly contributions. If you're in retirement and you're taking money out, you leave it alone and you take money out of something that did much better. So you're buying low and selling high. You've all heard it, but doing it is actually a whole nother issue. And we're going to wrap up here with international. The Vanguard International, total international Admiral shares for the last year was up 27.55%. And emerging markets, which is even more risky, it's a subset of international, was up 31.4%. So if you had money in international and emerging markets, you're talking, ballpark plus or minus a couple percent, 30% return last year. And that was an area that I used to have clients anywhere from 25 to 35% before 2008. But after 2008 and the stock market went down 37%, I saw that as an overreaction, which is partly why I'm pretty comfortable with the 15.25% earnings since then, because part of that is offset by the overreaction of the drop in 08, I think. But the international, I don't have that comfort level with the international as I do with the United States. So we went down to below 10% total. And now for most clients, I'm 20% or more, and that's slowly increased over the years. And that was the one point over the last couple of years I had to fight with some clients, because if you look at the 10-year performance, we're talking about 1.8 and 1.3%. That still includes the 30% you made this year. So international over the last 9 or 10 years has been terrible, making you next to nothing. You made more money. Well, not more, but you made almost as much money as cash as you did in international stocks. But then you get a year like this year where you make 30% in 1 year. That's why you have different asset classes. And at least international as a relationship to U.S. domestic, I'm more excited about international currently than I was a year ago, and more than I was 5 years ago. Definitely more than I was 10 years ago, because that's when I went to 10% international. So if you're close to retirement, the portion of your international might be 20% of your stocks. But if you're 30, give or take 10 years, it might be 40 or maybe even a little bit over that. But that's kind of some thinking. If you are on the younger side and you have the vast majority of your money in the U.S. stock markets, 10% or less, or 10% in real estate and about 20% international, the amount of money you made in this last year would be about 20, 21, 22%. So if you're someone in your 30 or 40s and you have, or even if you're older, if you have all of your money in stocks, you should have made something close to 20 to 22 to 23%. So if you are picking stocks, or if someone's picking stocks for you, or if you have a big basket of managed stock funds, take a look and see if you made something in that ballpark. And if you are plus or minus, fine, give or take, whatever. The other reference you can look at, and you're probably going to have a lot of if you work with somebody, they might be tempted to do this. They're going to show you the 5-year number, and a mix like I just described that was mostly U.S., but some real estate and some international. The 5-year mix might be more like 13%. But they might come to you and say, the stock market normally makes 10, you've made 9, you've done pretty well. Well, they didn't take into account that you should have done 13 and you made 9. Why are you losing 4% every year? Just things, you want to think about. If you have a big chunk in bonds, and I'm just going to do a quick and dirty on this, but if you had about, let's say, 40% of your money in bonds and 60% in stocks, so much more conservative portfolio, the return you might have made last year would be around 13.5%, 14%. So if you have 40% or half your money in bonds, because if it's half, it's going to be a little lower. But if you have half your money in bonds and you made 3 or 4% last year, you have a really serious problem. Why didn't you make money? More money. The 5-year return on all of that, about 40% in bonds, is 8.5% to 9%. So again, look at your performance numbers and see if you're in the ballpark. If you are, great. If you're dramatically under, take a look into it. Figure out why and see if it's something that you can fix. You may have some really bad mutual funds. You may have investment products that are just absolutely horrible. So that's some thoughts about that. The last thing I'm going to do is talk about how big the cushion should be. And normally I will tell people the cushion should be 10 to 12 years. I have a different way of measuring it. It's not as a percentage of your portfolio. It is as the number of years that it will protect you when the market goes down. Normally I say 10 to 12. Last year, January of 2017, I said that was now +1. So between 11 and 13 for most people. I'm going to add another +1 to that going into January of 2018. And this is something that I've talked to a lot of my clients about. More importantly, the clients that are closer to retirement and the clients that have a bigger part of their portfolio with me and not somewhere else. And, the different factors, but we've been talking about this for months. And, they get the information and my thoughts before you do because they're paying me. And I think that's only fair. So if you are building your cushion, if you've gotten to that point, we're now looking at a range of 14 to 12 to 14 years. What that means is that if you're 14 years from retirement, you should now start thinking about building the cushion. Don't get nutty. And the question is, why am I doing this? This is a very small step towards slightly more conservative overall. This does not apply to someone who's 20 or 30 or even 40, or most people that are even 50. Over 50, 55, yeah, it probably starts applying to you. But for the younger people, because I don't know what's going to happen with the market. And if you put a whole bunch of your money in bonds, you could miss out on the next several years of really healthy stock market returns. So take the risk. Don't worry about it. If you're 30, you've got 35 years before you start taking money out. You might live 60 years. So don't worry about what's going to happen next year. However, if you're 4 or 5 years from retirement, you want to be thinking about it pretty hard. And so normally I have 10 to 12 years of cushion at retirement, and I'm now saying +2, that means 12 to 14 years of cushion. So at retirement, you should have that loaded in. And if you want to know how close you should be to that, if you're 5 years from retirement, it's 12 to 14 minus 5. So you should be 7 to 9. And that means that you're going to be pretty close to being able to fully retire, even though you're several years out. There's all kinds of variations with that, depending on your income, if you have 2 incomes, if one income is bigger than the other, if you have Social Security and pension or not, you have a rental property, you have real estate. All those things make it so complicated for me to give any kind of meaningful answer in general. But my 10 to 12 year normal historical cushion, I added 1 last year. I'm adding 1 more this year. So a slightly smaller percentage of your money should be in bonds. If you want to break it down to your portfolio, if you've already got something set up, consider it a 3 to 4% shift. So take 3 or 4% of your total stock portfolio and move it over to a bond portfolio. So that's kind of where I'm thinking. The big part is because 15.25% for the last 9 years, while it's not crazy, particularly because the year before that was a 37% drop, it's pretty healthy. And we just made 22%, for crap's sake, in 2017. That's not epic or historic, but it's a good, healthy number. And that's, followed by a string of several good years. There were 2 in the last 9 that only made like 1 or 2%. So it's not crazy. It's not like the late 90s where we made 20 to 30% per year, but it's healthy. And so if you're close to retirement, take a little cream off the top and just rest at ease. If you're 20 plus years, 15 plus years from retirement, don't change anything. Don't change anything. Even if the stock market drops 40% this next year, in the long run, it shouldn't matter. So that's some thoughts about that. Of course, if you want help or if you want me to review the statement that you just got because you don't understand what you own, which is something you should fix, email me, phil@polarisfinancialplanning.com. Please do not send the statements until you at least get an email back from me. It would be helpful if you include your phone number because I like to talk. I can call you. We can chat a little bit. And then if you still want to, you can send me statements. So that's the super double long investing skeptically. We're going to take a little, 10-second musical bump here. And then we're going to go into our interview and we're going to talk about the law some. All right, everybody. Welcome back. This is Phil Ferguson. And of course, you are still listening to the Phil Ferguson Show. With me today, I have Charone Frankle, and she has her own podcast called Habeas Humor. How are you today?
Hi, Phil. I am great. Thank you so much for having me on the show.
It is not a problem at all. I'm so delighted you are here. And I've been listening to your show. A lot of good stuff about, what do we call this? Legal things, law things?
Law talking stuff. Yeah.
Yeah.
Thank you.
Law stuff. Like I always say sports ball, but I don't know, law ball. That doesn't really work. So you talk about that, and we'll talk about some of those things. And recently, you got on a little bit of a Putin kick.
I did. I got sucked into a Putin vortex. It turned into a 3-episode series.
Putin vortex. Well, before we get into the Putin vortex, I'm going to keep using that. I love that. Why don't you tell us a little bit about your show and how it got started?
Okay, great. Well, it's called Habeas Humor, or if you're British, Habeas Humor, as Benedict Nicholson from Kevin and Benedict always says. He always corrects me on my own show. Habeas Humor. And it's actually in my head because now I like to say it like that because I'm kind of a stickler for proper pronunciation of Latin words and stuff. I have a singing background, so Latin music is something I've sung a lot. So then I kind of kick myself a little bit when I say habeas, because that is definitely the American lawyer pronunciation of it. But in my head, I'm like, habeas. So the idea of the show, it's a little bit like your show in the sense that I kind of combine worlds. Like your show is finance or investing, and you like to do atheism and social activism things. And so I like those things on my show, too, because I want that same community to listen to my show. But I also, the things I can offer is I have somewhat of a comedy background. I study improv, and I'm not really a stand-up, but I have listened to stand-up all my life. I like to think I've absorbed some funniness from that. And so I like to offer humor for the show. For me, the number one goal is to be entertaining. Educational is like a distant second. In fact, when I started the show, I was trying to not be educational at all. I wanted to do more like, more Saturday Night Live-y legal analysis where it's just jokes. But I'm just apparently not that funny. So I have found that I have to at least be somewhat informational to get people to be able to get something out of the show, because otherwise they could just turn on someone who's actually funny, like Samantha Bee.
Yeah, I was just thinking of, what was the type of humor you just mentioned? The words just have escaped me, where you stand up and just improv. Thank you. Of course, this ruins the joke too, but I was going to say, you think you're good at improv? No. How's that? See, because you never say no in improv.
Oh, yeah. No, yes, the answer would be yes, and I am fabulous.
So I was see, that's why I don't do humor either, I guess.
Well, yeah, you're in the mecca of American improv there in Chicago.
I'll take your word for it because they can't get real jobs.
So I do that. So I like to bring some of my expertise about the law and also some funny stories. I had gotten feedback in the past saying, like, when you talk about just how certain cases are funny, like someone falling through an outhouse into a cesspool, like that's great, but it's like not really robust legal entertainment. So you should talk more about what I try not to do. There's another show called Opening Arguments, and I don't know if you've heard of them.
No, we don't. They're the ones that shall not be named.
So, they came first, and they are much better at doing things like giving kind of little seminars on the law and really being like kind of a little mini course on things and being really informative. And so I'm not as good as that, so I don't try to copy them. I don't try to outdo them on their own format. So for me, it's more about I like to look up what's going on in the news and then just kind of go from there and make fun of it. There was an episode I did once where I covered the defamation lawsuit between Pete Rose and John Dowd and went into all the details of that and got to make lots of jokes. When you're a comedian, you try to push the limits of what you can make fun of. Pete Rose having sex with 14-year-old girls. There's a joke in there somewhere. So
wow, I figured at least he'd get the second base.
See?
Yeah, how's that?
That was excellent.
That was a sports joke I made, and I don't do sports ball. That was pretty impressive.
Yeah, whenever I can make a joke about sports, I'm the same way. I'm like, oh, I just made a joke about a sport thing.
That may be my Costanza moment right now. Wow. Okay, so you've got all that, and you do that. So you said you have expertise in law stuff. So are you an attorney? You have a JD? How does that work?
Oh, yeah, I kind of forgot to mention that. I am a lawyer, as Star Jones would say. I studied at the University of California, Davis for my law degree, and I graduated in 2005. And I've been since then in a few different kind of firms where we did different things. I've done just kind of what you would think of as run-of-the-mill civil litigation, which is lawsuits for accidents and lawsuits over contracts and things. And then I was with an insurance company doing what they call PIP. I think they have that in Illinois. That's like the first party coverage for medical bills, where the insurance company kind of steps into the shoes of your health insurance and pays medical bills. And doctors are often unhappy with what they get paid. And so we would do arbitrations with them. I did that for 6 years. And then now I'm actually in solo practice, and it's just getting going, and I'm actually going to be doing kind of business law and also whatever else I can I'm also trying to see if I can maybe do some medical related things, since I have a lot of expertise in that. It does get, we were talking previously and you were asking me about how it can be, like if you do one kind of thing, can it be cross applied to another area? And what I was doing for 6 years was extremely esoteric. It was only New Jersey law and only insurance. So I didn't really get a lot of skills that can cross apply to other areas, except for everything I learned about medical billing and Medicare.
That is fantastic. I know that when I worked for the man and did a lot of stuff with pharmaceuticals, generic pharmaceuticals in particular, and the pricing games that go on there, is a very incredibly small universe where I can use that specific skill set. So, that can be good as long as you're employed, because very few people know what you know. But if you leave that little crack, that little corner, it can be hard to find something else to do with that information.
Yes, totally. I actually did an episode a while back on pharmaceutical. I think it was called Pharma Fraud or something. I was focusing on like the fraud cases that had been brought against pharmaceutical companies, and then also the work that Doctors Without Borders was doing to try and get more affordable vaccines for children in the third world who don't even have pneumococcal pneumonia vaccines.
Oh, well, I like that. It's one of those things that, at least with drug prices, it's arguable that they're too high for a lot of people. And it's also arguable that if companies can't make money on new drugs, they're less inclined to research them. So I don't know off the top of my head what the right answer is. But so you've got this show. We've got some of the topics that you've covered. And you recently went into the Putin vortex. Why don't you tell us some about that?
Yeah, so I was inspired to do that for a couple of reasons. One was because Russia always comes up in the news, as we all know. And Putin does seem like kind of a shadow overlord, since it seems that he really controls Trump, and apparently I mean, I said it on my show. I think he may have access to every secret thing that Trump knows. I mean, Trump had those people in his office. So, and everyone in the country was like, what the fuck? Why would you do that?
Well, only about 60%, because there's still a 30 to 40 that think Trump's doing a pretty good job.
Oh, great. So, yeah. So there's that. And then I was listening to another show. I don't know if you listened to it. Stay tuned with Preet, which is Preet Bharara's show. He was the U.S. Attorney for the Southern District of New York under President Obama, and then he was briefly there under President Trump, and then President Trump let him go along with a lot of other U.S. attorneys. So now he has a podcast. And he had, I'm sure you know who Bill Browder is, right?
It's not ringing a bell, I'm afraid.
Oh, you guys are both like investment people. I thought you would know.
Oh, yeah, we know each other. I live in a bubble.
Oh, okay. Well, to be fair, he has been mostly involved in things outside the United States. He's from the U.S. In fact, I think he's from your area of Illinois originally. His grandfather was the head of the American Communist Party, like in the 1920s, and ran for president.
I feel even better that I don't know him.
So he was like a real life Alex Keaton in the 1980s, and he decided, like, he comes from this communist family, so he decides to become like a capitalist to rebel against them. He goes to Stanford Business School. And then he decides to go to Eastern Europe and try and make money as an investor out there. He makes a ton of money. He ends up setting up in Moscow right after the Soviet Union dissolves. And he becomes the largest. He sets up a company called Hermitage Capital. And he invests in these Russian companies and that had started selling off shares. And he would take people's money, like people from usually outside Russia, like people from the Middle East, people from Europe, and buy and like make funds. And this was like on my show. I'm like, I don't really know the difference between a mutual fund and a hedge fund, but like it was some kind of fund, and he was buying shares. And all I know is he bought low and he sold high and he made billions.
Well, that's the essence of it. Yeah. Of course, it helps if you have secret ways to buy low.
Well, that's the thing. He claims, now, of course, all my information mostly comes from his side of the story. He has this book out that's a bestseller right now called Red Notice. And this is about how he started to discover, he says, in the last 10, 20 years, that these Russian oligarchs, as they call them, these billionaires who like own half of Russia, seemed to be making all this money and stripping assets from the companies that they own shares in. And he decided to find out, because he's like, my investments are like, I own all these shares of this company, and this company's not worth a bunch of money like it should be. What's going on? So he would find that these Russian oligarchs were doing these things. And again, you might know more about it than me, asset stripping and all this stuff where they would basically loot the company, move money out the back door to their own accounts. And like if they had an oil company, they would sell oil at $1 a barrel to their private company and then sell that on the market at $50 a barrel and then take the profit and that kind of thing. And then the company would take the loss. And Browder says that Putin basically became partners in this theft. Putin said to these oligarchs, like, you'll cut me in for 50% and I'll let you keep doing what you're doing. And so Browder says that he and his tax attorney, Sergei Magnitsky, uncovered this fraud. There was one instance where a bunch of Russian goons took a fraudulent tax refund from the Russian government of $230 million and went and stashed that money overseas. And they found all this out, and then the Russian government under Putin went after Bill Browder and Sergei Magnitsky. Browder was already out of the country. They deported him with extreme prejudice. They actually, before they tried to arrest him, they deported him, so then they couldn't arrest him. But Magnitsky was a Russian. He was still there, so they took him off to jail and tortured him for a year and tried to get him to like falsely confess to all this stuff to cover for them, and he wouldn't do it. So they ended up murdering him. And so as a result of that, we have, due to what Bill Browder says were his efforts in conjunction with Senator John McCain and Senator Cardin from Maryland, they passed a U.S. law called the Magnitsky Act, where the United States will, anyone who is listed as a human rights abuser, like people who were involved in killing Sergei Magnitsky, they will be banned from the United States. They will go on the U.S. Treasury sanctions list, where supposedly they can't open a bank account anywhere in the world. Their assets will be frozen because they have all these foreign accounts where they hide the stolen money. So the U.S. has that. Canada has stuff like that. Canada recently passed a similar act, and also there are some European countries that passed similar acts. And apparently Putin is outraged at this, and Putin has been trying to basically arrest or kill Bill Browder. So I haven't even read his book. That's just kind of what I've learned from him, from his articles and appearing on other shows. And I still have to read the book, and there are some unanswered questions and stuff. And again, it's all from his side of the story, but that's kind of the deal with that. And so I thought that was fascinating. And I ended up I was like, okay, so what is Putin? Because Putin, again, a lot of influence in the U.S. Trump seems to really admire the way Putin does things. So I figured I should find out more about Putin and maybe what we should do to try and keep our own country from becoming like Russia, where they have this capitalist system that lets these people become billionaires and kind of basically by stealing. That's pretty much it.
Now, you had mentioned, what is it, that Magnitsky Act? Mm-hmm. Am I saying that right?
Magnitsky, I believe, yes.
Tell me more about that. What is that, and why is that in the news?
It is, I think it has been in the news lately because there were certain people that were added to it. And it was funny because I would see this stuff on Twitter, and these idiots on Twitter thought that this was about Hillary Clinton and Pizzagate. They thought that they basically didn't even know this was a 10-year-old law. They thought that this was something that President Trump just did by executive order. And I mean, because he made an executive order adding people to the Magnitsky list, but he didn't invent the Magnitsky law. That was actually an act of Congress. And in fact, according to Bill Browder, it had to be an act of Congress because President Obama didn't want to do it by executive order, even though he could have. Apparently, President Obama was suffering from the same syndrome that every American president has had when it comes to Russia, thinking he can fix things himself, and he didn't want to poke the bear. So he actually didn't want to enact that stuff, but it was extremely popular at the time. I want to say it was 10 years ago that was passed, 8 or 10 years ago. I guess that would make sense because Obama was in there from...
Yeah, he was in for 8 years, and Orange Head has been in there for almost a year now.
Yeah. So, I mean, it had overwhelming bipartisan support, so Obama just had to sign it into law eventually. But it is an act of Congress, which makes it difficult for Trump to repeal. And Trump was asked to repeal the Magnitsky Act, or at least try to, by, we all know about this Trump Tower meeting that Steve Bannon was just talking about with Jared Kushner and Donald Trump Jr. and Manafort, where they met supposedly in 2016 with Russian attorney Natalia Veselnitskaya is her name. And she actually works for those Russian oligarchs I mentioned that supposedly steal billions of dollars. And what she apparently was coming to talk to them about was she wanted to get from them a promise that they would repeal the Magnitsky Act, or at least make every effort if Trump won the presidency, because she works for two, and I can't remember their names offhand, and I can't remember exactly what their connection is. I think they are under sanctions either from the U.S. or from other countries, and they were implicated. Now I'm really confusing the facts because I'm going from my memory.
Well, what I'll do is I'll say, if you want to hear more, you've got to go to Habeas Humor and get all the details, because you have done 3 shows that were how long in total? Like 3 hours?
Something like that, yeah.
And so you've done all this research and you've laid it out. And I mean, and and we can talk about it on your show. I recently did a double Bitcoin thing, and you've done a triple Putin thing.
I win.
a three point Putin vortex, something like that. I don't know.
So yeah, I go into as much detail as I can. I looked at a lot of sources because I was trying to get corroboration, and then every time you read something, there's something else that you want to read more about. so-and-so died under suspicious circumstances. And you're like, I got to find out about that.
Yeah, there seems to be a lot of allegations, at least, that people spontaneously die. And I know that Ukraine in particular has had trouble with that because Russia meddles with their government. So I don't know. I just find it hard to believe that there is a generous portion of the population that even just 10 years ago would have seen Russia as the enemy to the world, that now is kind of like, they're not so bad. It's like, how did that happen? How did we go from paranoia and commie fear and the Red Scare to Russia's probably not really trying to meddle in our elections? Really? You believe that?
Yeah, well, I mean, it's especially under Putin, and I honestly didn't know much about him. He became somebody who was in the news a lot when I was in college, like in the early 2000s, and I really wasn't into the news. I was like, this is depressing. So I didn't know much about Putin then, but I had thought more or less that ever since the fall of the Soviet Union, it was more China that we were considering the big threat.
Yeah. So, and then of course in the news, I've heard this great line that Trump is making China great again. I don't know if you've heard that. No, but yeah, we certainly have become. We like China now. We're like, China, you got to talk to Kim Jong-un. Like, we're relying on them too. Well, yeah. So we're ceding world power in negotiations and in examples like that, and we're also removing our influence and our money because of a little bit of xenophobia in the United States, where we don't want to get involved in countries around the world, which some could make an argument that that's a really good idea. I'm willing to discuss that. But the problem is, if you leave a power vacuum and don't leave correctly, then Russia and China just step in. And so you have not fixed any of the problems, and you just have a different foreign country interfering in their politics and stealing their resources. So that's not cool either.
Right. And China, did China sign on to the Paris?
I believe China is part of the Paris Accord. Last I heard, the only two countries that are not are the United States and something like Syria. So yeah, they're better than us in some. Yeah, in some weird way. And of course, you and I talked briefly pre-show, and not that the listeners can ever get the pre-show because it's not recorded. But in the pre-show, because that sounds so magical. We talked about the fiduciary rule for advisors, and since you kind of have this lawish thing going on, you want to talk about that a little bit, and the big delay, which I can't believe only just a couple of days ago, even though this happened a month ago, did I become aware of this delay. What can you tell us about that? I'd love to talk about it. So as folks may have heard back in March on episode 50 of the Opening Arguments podcast, sorry, I had to put that plug in because Andrew Torres and Thomas Smith have threatened to do terrible things if I do not constantly promote their show. I will send them a bill. Don't worry. And promote the liberal hoax that Andrew Torres knows about law stuff. Yeah. Well, by the way, as far as I'm aware, I am the only guest contestant in their legal quiz show. You're not the only one, actually. Did you get it right, though? You may be the only one who's gotten it right. I am 100% for every time I've been on. Yes. Yeah. So, yeah, in your face, Andrew Seidel and Denise Howell. Oh, so I think I'm pretty sure I was the first. So maybe we had so much fun they decided to add more people. But I am 100% accurate in the challenge. Yes. So I'm very excited about that. So so as you would have heard from that show, America used to have different leadership. In a bygone era, we had a president who used the executive branch of the government to help regular Americans like yourself and me. And there was this thing called the Department of Labor. And it would provide services to those who do labor rather than just those who exploit laborers. Right. So one thing that executive departments, such as the Department of Labor, have the power to do is enact rules and regulations. Congress delegates that power to executive agencies so that Congress does not have to draft every little picayune thing. Like, for example, how they always tell you on airplanes that you cannot tamper with the smoke detectors in the bathroom.
Actually, in my effort to make sure that I was correct on this example of regulations, I went down to a little rabbit hole in research, and it turns out that the rule against tampering with a smoke detector in an airplane is part of the United States Code. So that means Congress did pass it, but the rule that says airplanes have to have signs to tell people that it's against the law to tamper with the smoke detector is a Federal Aviation Administration rule, not an act of Congress.
It's one of those things that I will kind of dabble in taxes, and I'm not an expert, listeners, by the way, but there's a lot of things where Congress will make a law and the IRS will have to decide how to implement that law, and they start making rules about who pays taxes for what. So
yes,
kind of the same kind of thing. And what have you learned about this fiduciary rule?
So the rule that the Department of Labor enacted during the Obama administration said that going forward, there will be a fiduciary obligation imposed on professionals who do financial advising or financial planning. I'm not sure what the difference is for retirement, though. It has to be for retirement.
I know the difference between those two words, by the way.
Yay.
There is none.
Okay.
Yeah. Unfortunately, all of those terms are not properly defined, and it has been kicked around, but it's way off the list of things to do now.
Okay. So as anyone who listens to the Phil Ferguson Show knows, people who service consumers in the investment industry are not necessarily bound to act in the best interests of their customers, and they often do not. And you may be sold an investment not because it's the best investment for you, but because it will make money for the person you buy it from.
And it's funny because when I talk to people and I tell them that, they're like, wait a minute. What? Wait, what? The advisor that I'm paying or not paying, which is the most dangerous part, I think, doesn't have to act in my best interest? How in the fuck is that possible? So I tell people just to think of it as like a used car salesperson. I hate to pick on that industry all the time, but they work for the dealership. And when you see an advisor, they work for Merrill Lynch or John Hancock or whoever. They don't necessarily work for you. So Department of Labor made a rule, and what did it do?
So it imposed this fiduciary duty, and fiduciary is a legal term of art. Someone who is a fiduciary has a legal duty to act in the best interests of whoever it is that they're a fiduciary for. So, for example, trustees are fiduciaries of a trust, so they have a legal duty to always act in the best interests of the trust and the beneficiaries of the trust. It works that way. So anytime you hear the word fiduciary, it's referring to somebody who is who's like accountable for working in the best interests of whoever they're a fiduciary for. So if a financial planner is now required to be a fiduciary, that means it is against the law to put their own interests ahead of the client's. They have to make sure that all advice they give is in the best interest of the client. In the specific case of the Department of Labor and their rules for retirement planning, here's the story. And Phil, I am a rube when it comes to knowing about financial stuff, so I looked this up on Investopedia.
I love
and if I say something wrong, please call me out.
Yeah, well, I'm sure you'll do fine.
Okay. They give this, and I can send the link if you want it, they give this history of the fiduciary rule. They say that originally the Department of Labor regulated the quality of financial advice surrounding retirement under ERISA, which is ERISA. Do you know what it stands for offhand?
It's funny because no is the short answer. And Labor Relations Act something, but it has to do with 401ks, IRAs, Roth IRAs, retirement planning for employees.
Okay. So that was all I do know from Investopedia, that it was enacted in 1974. And it had never been revised to reflect changes in retirement savings trends, particularly the shift from defined benefit plans to defined contribution plans and the huge growth in IRAs. So a set of reforms was proposed back in 2010, but it was quickly withdrawn in 2011 after fierce protests from the financial industry regarding regulatory costs and liability costs and client concerns. Obviously, they don't want to have more responsibilities. Yeah. But 5 years later, basically President Obama was like, I'm in 2015, he was in his second term, he was almost done, and he was like, fuck it, this is going to change. So he proposed, on February 23rd, 2015, Obama made this speech saying, "Today I'm calling on the Department of Labor to update the rules and requirements that retirement advisors put the best interests of their clients above their own financial interests. It's a very simple principle. You want to give financial advice, you got to put your client's interests first.
Well, it seems so straightforward, right? I mean, that's easy.
Yeah, well, yeah.
One would
so
imagine.
They did what he said.
Yeah,
he's the boss of the Department of Labor. So
they came up with some rules, and they were going to implement them, and then Trump, maybe?
Yeah. So the Department of Labor proposed the new regulations on April 14th, 2016. And this was the price of waiting until he was basically lame duck, is that he's running out of time, Obama. Actually, they approved the rule very quickly, and President Obama endorsed and fast-tracked the implementation. And, they do what they always do when they're making new rules like this. They had public hearings. They, let the public comment on this. Yeah, so they made this rule that says if you are advising someone on retirement investing, you have to act in their best. You are a fiduciary. You have to act in their best interests. And that, as far as I know, that's like the law in a nutshell. Yeah, like you said, astute listeners will take note of the fact that there was a regime change right before this law was supposed to take effect. It was supposed to take effect because what they do is whenever there are new rules, they always are given an effective date. It's like usually a few months in the future to give people time to prepare and get into compliance. So the fiduciary rule for retirement planning was supposed to become effective in April of 2017. But starting in March of 2017, the Department of Labor, they started to make new rules that kept delaying the implementation of the fiduciary rule. So it kind of like a stay of execution, like this person's supposed to be executed. I'm anti-capital punishment, by the way, but example. They set it for February 1st, and then they do a stay. Now it's March 1st. Now it's April 1st. That's what they were doing. And very shortly after Donald Trump was sworn in as president of the United States. My stomach does not agree with that sentence.
It's hard to say.
I feel a little nauseated.
and they delayed it all the way until January 1st of 2018. And I assumed it was going to stick. I was surprised, and I moved on with my life, and I completely missed what happened in the fall. And that was what?
It got pushed back another year. Are you shocked?
I actually am shocked because I know that several big broker-dealer firms, some of the people that are the worst at representing their clients, had started making changes to be compliant with the January 1st deadline. Yeah. I would talk to people in the industry, and they said, well, we believe in this. We think this is great, and we're making all of the adjustments necessary to be in compliance with this rule. And I said, well, if you like this so much, why weren't you already doing that? And they don't have a good answer. But now it's delayed 18 months to July 1st of 19.
Right, which will be after, hopefully, a new president new Congress. Yeah, because we don't have presidential until 2020. Damn, wishful thinking.
Yeah, it's going to be pushed back. And do you think it's going to survive this, or is this just a long enough extension that they can come up with a plan to actually kill it?
Maybe it's intentional to wait until after midterms, and maybe that will take the pressure off of the people who are the Republicans who are in power now, and Trump included, because obviously President Trump seems to be much more willing to yield to the desires of big banking and big finance than Obama was, and also, as far as I know, I'm not a big expert on what kind of politicians get what from what companies as far as contributions. But as far as I know, the big banks and stuff are more supportive of the Republicans than the Democrats, I think.
Well, that seems to be the case. But if they're not more supportive of Republicans, they're getting more support from Republicans. How's that sound?
That's certainly true. And by the way, I hear, to be fair, I have heard, especially on the Dollop podcast, I always do this thing where I promote other shows. I can't help it. They did a whole thing on opiates and Purdue Pharma and the whole history. Yeah. And they were talking about were you going to say something?
No, I was just very fascinated by that. I actually had on an opioid abuse expert on my show several months ago.
Yeah, it's, because it's a big deal now. And they were calling out the Democrats because apparently the Democrats, a lot of their big support comes from pharmaceutical companies. So a lot of that is really on them.
Yeah, and of course the support comes from the money, and pharmaceutical companies have money. Financial services and banks have money. Doctors have money. Military industrial complex has money. So as long as politicians are willing to, at least sometimes, I'm going to give them some wiggle room, vote in favor of where their money comes from, we are going to have limited control as citizens over our government.
Right. And, it's possible that if, fingers crossed, we get a Democratic majority in at least the House. I mean, it'd be nice if we get the Senate, but the numbers aren't in our favor there right now, as far as I know. Again, I'm always constantly looking up this stuff because I'm like, wait, how many seats are up? Like, I do not have it memorized. So if I say something wrong, I apologize. I'm a law talker. So, but yeah, like if Democrats are in control after the 2018 elections, then Congress can just enact this as a law and say from now on you're a fiduciary if you're advising people on retirement, and and then Trump and the Republicans will have to be like, well, they're in control now. Sorry, big donors.
Yeah, I don't see that happening. I just see Trump vetoing it, and they won't have 2/3 majority, so it still won't solve it. Well, excellent. What else have you had on your show lately that you would like to share with us?
I was recently, my very last episode was about voter suppression, very much relevant to what we were just talking about.
Yeah.
Because we all are trying to, I said in my show, we'll be taking pitchforks and glow sticks because we can't use torches now. Now that's a Nazi symbol, but we're going to be like out in the streets being like this mob, making people vote, like dragging people from their homes and taking them to the to the polls to make them vote or whatever, because everyone has to get out and vote, because one of the big reasons that Hillary Clinton lost the Electoral College is so many people just were apathetic. I'm sure I don't have to tell you, it's really important everybody vote, and the Republicans, you can expect that they are going to do whatever they can to try and get minority voters, Black and Latino voters, people who tend to vote Democrats, keep them away from the polls. And Alabama right now has done that with their photo ID law that was in place during the election between Doug Jones and Roy Moore, where Doug Jones squeaked by. And that law is being challenged right now in federal court in Alabama and is scheduled to go to trial in February. We'll see, because trials often don't go forward when they're scheduled to, but like challenging those kinds of laws is really big right now. I talked about that on my show. And then I talked about the Commission on Election Integrity that Donald Trump set up. And as of yesterday, it was in the news that it was just dissolved right after I did my show on it, which I'm taking credit for.
That's right. You should. That was a farce to start with, and it just went downhill from there. And so now it has served its little political agenda for Trump to say there was voter fraud and he had a commission, and the Democrats just fought it the whole way and had all these lawsuits. So he is winning by stopping the process.
Yeah, pretty much.
He's always winning, even when he loses.
Yeah, and if you want to hear about like all the ethical, like, all the things that Chris Kobach, who was the vice chair of it, was being sued for. He's trying to become governor of Kansas right now. So, I go into a lot of detail on that in my last episode, which I believe was 36. And then coming up, I'm going to have, I don't know how much you want to go into it on here, but we're definitely, when I have you on my show, we're totally going to talk about the American Atheist. I had one of their attorneys, Jeff Blackwell, do an interview that's going to be the next episode out. And we're talking about their upcoming convention and everything. Well,
that works out perfect because I just had David Silverman on. So listeners that catch that show and then this show should go check out your show to hear more about the legal goings on of American Atheists. And, of course, your show, again, is Habeas Humor.
Genius segue.
Oh, my gosh. I got it. A little tickle in my throat I can't get rid of. And, of course, it's available on all platforms. Where can people reach you if they have questions or emails or Twitter or something like that?
You can get the show on iTunes. A lot of people have trouble spelling habeas. Like, I had thought that, like, since the Patriot Act, like, everyone would know this as part of their, vocabulary, but no, not so much. So it's HABEAS HUMOR. That's also the Twitter at Habeas Humor. And then my email is actually abbreviated, so it's Habe, Habe, HUMOR at Gmail. And you can get the show iTunes, Stitcher, Google Play, all that.
Excellent. Well, Charone, thank you so much for being on The Phil Ferguson Show.
Thank you. This was great.
You're listening to The Phil Ferguson Show.
I certainly do hope that you enjoyed the interview with Charone Frankle. And of course, you go check out her podcast, Habeas Humor, especially if you have some interest in the law. Go check it out, and I'm sure you will enjoy it. I actually have more stuff to cover, but I'm going to end it now because I'm guessing at this point we're an hour and a half long podcast. My goal is around an hour, give or take, but I rarely achieve that. The one last thought, I did have an email question. Someone said, hey, Phil, I've heard you mention before how you learned Italian, and how was that? The thing that I started with was Pimsleur, Pimsleur, Pimsleur. The nice thing about that is, since I'm a talker, when I wanted to go to Italy, I didn't want to read a book. I wasn't going to write a book. I wanted to talk and be able to hear what people were saying. So Pimsleur, by far, is the number one thing for me. I should have commercials on my show, or I should get commissions or something, but I don't. But I love it. I love it very much. My experience was I did an hour a day for 5 months, and I could communicate. I got my little air quotes up. I could communicate. I couldn't conjugate. I couldn't do long sentences, but it blew my freaking mind that after 5 months, because I had French in high school and college for 4 years. I could never say anything. I still can't even say more than like "Respondez-vous s'il vous plaît," and it probably sounds like I'm saying it in Italian. But 5 months, an hour a day with Italian, and I could communicate with Italians in Italy, and it kind of freaked me out and changed my world view on that. So I've been doing it for 5 years now, and yes, I've used other things, but Pimsleur was the thing that allowed me to pronounce the words correctly, to be able to hear what people were saying and understand them. I still sometimes feel like a little kid when I'm reading something, but that's gotten much better over the years. But that wasn't my main driver. So Pimsleur, again, a long show. If you really like the long show, send me an email. If you really like the short show, send me the email, and I'll see how that scale weighs out. But otherwise, I'm going to wrap up. Thank you so much for listening. If you'd like to leave a review, you can do so at iTunes or Stitcher, are the two places that I'm aware of. If you are getting value from the show, I do not have a Patreon account on purpose. I do not want your money. Oh, I almost forgot. I am so glad you reminded me. Go to atheists.org. It's atheist with an S, atheists.org/Phil, and you can go sign up for a year membership of American Atheist for $5. It still costs $35. You pay $5, I pay $30. That's right. The way you can reward me if you find value in this show is you go spend $5 and make me spend $30. Last I heard, there was something like 30 or something. There may be 40 people have signed up for that already. The limit is 200. If 200 people sign up for that program, I will be out $6,000. It is only for January and February. You've been thinking about it. You've been meaning to do it. So this is my way to get more members for American Atheists. Go to atheists.org/Phil and sign up. You'll have to pay $5. If you feel bad about it because you actually have $35 and you feel bad taking $30 from me, still pay the $5 and then donate some freaking money. So you can donate $30 to make back, because it doesn't go to me. It goes to American Atheists, so you're helping out the cause. You could donate $1,000. People did this last year when I did a fund drive for American Atheists, gave hundreds, and a couple people gave considerable amount of money. You can still go do that. Anyway, thank you so much for listening. I appreciate all the referrals and all the reviews. It is very, very nice for you to join me. And I do hope to see you at the American Atheist Conference at the end of March in Oklahoma City. Until then, ciao.